I need to show you something. A document. Published January 30th, 2026. Most people scrolled right past it. But buried in line 6061 is a name that changes everything. J.P. Morgan Securities. 147 contracts closed. On the exact day, silver crashed 39% in 6 hours. The same bank that paid $920 million for rigging this exact market. They closed their shorts at the perfect moment. At the bottom. You think that was luck? That is not luck. That is a heist. And the evidence is sitting in plain sight on a government website that anyone can access. We are told markets are free. We are told prices reflect supply and demand. We are told crashes happen because of panic and fear. That is the story. But the ledger tells a different truth. The ledger says this was not a crash. It was a liquidation. And someone knew exactly when it was coming. Let me take you back 72 hours. January 27th, 2026. Silver is climbing. It has been climbing for weeks. $30, $40, $50. The headlines are screaming about inflation and currency collapse. Retail traders are piling in with everything they have. Hedge funds are going long. The momentum is unstoppable. By January 29th, silver hits $121 per ounce, an all-time high. People are talking about $200 silver, $300 silver, early retirement, financial independence. The forums are on fire. The YouTube videos are euphoric. Everyone is a genius. Everyone is getting rich. The world feels like it is finally waking up to the truth about paper money. And then the floor drops out. January 30th, 6 in the morning, before the markets even open. President Trump announces Kevin Warsh as the next Federal Reserve Chairman. Kevin Warsh is a strong dollar hawk. The exact opposite of what Trump signaled just 3 days earlier. 3 days earlier, Trump talked about weak dollar policy. Every trader heard the same message. Weak dollar means strong commodities, strong gold, strong silver. That was the trade. That was the setup. And 72 hours later, Trump flips the script. Strong dollar Fed chairman. The reversal is instant and brutal. Silver opens and immediately collapses. $75 by noon. $46 erased in 6 hours. 39% gone. Margin calls are firing across the planet. Retail accounts are getting liquidated. Fortunes are evaporating in real time. The social media euphoria turns to panic, then anger, then silence. Trillions of dollars in paper wealth wiped out before lunch. The biggest single-day crash in modern history.
Everyone is asking the same question. What just happened? But here is what nobody noticed. Here is what kept me digging for 3 days straight. The miners barely moved. Silver crashed 39%. The mining companies dropped 22%. That should be impossible. Miners always move more than silver. Always. It is one of the most reliable patterns in commodities. If silver goes up 10%, miners go up 20%.
If silver drops 10, miners drop 20. This relationship has held for decades. It is the leverage multiplier. But on January 30th, that pattern shattered. Silver fell 39%. Miners should have crashed 60%, maybe 70, maybe 80. But they did not. They dropped 22. I stared at that chart for hours, and then it clicked. Smart money did not sell. The institutions did not panic. The hedge funds holding mining stocks looked at the silver crash and said, no, we are holding. Why would they do that? Why would billion-dollar funds hold mining stocks when the commodity those companies depend on is in freefall? There is only one explanation. They knew. They knew the crash was not real. They knew it was paper manipulation. They knew the price would recover. So they held their physical assets and waited. That thought sent me down a rabbit hole. If smart money knew this was fake, there has to be a trail. There has to be evidence. So I pulled up the COMEX delivery report, January 30th, 2026. This document is published every single day by the CME Group. It shows exactly who is trading, who is closing positions, who is taking delivery of physical metal. Most people have never seen this document. Most people do not even know it exists. But it is public. Anyone can access it. And what I found made my blood boil. Line 6061, JP Morgan Securities. 147 contracts stopped. In futures trading, stopped means closed. Exited. If you were short and you stopped a contract, you just locked in your profit. JP Morgan was short silver. And on January 30th, at the exact bottom of the crash, they closed 147 contracts. Maximum profit. Perfect timing. Think about what that means. Thursday night, silver is at 121, all-time high. 12 hours later, it is at 75, and JP Morgan closes their shorts at the exact lowest point of the day. Not Thursday when it was high, not in the middle of the crash when it could bounce. At the bottom, precision timing. Now let me tell you who JP Morgan is. September 2020. The Commodity Futures Trading Commission convicted JP Morgan of manipulative and deceptive conduct in precious metals markets. The scheme ran for 8 years. Hundreds of thousands of fake orders. Spoofing, that is what they call it. You place a massive sell order you never intend to execute. Other traders see it and panic. They start selling. The price drops. Then you cancel your fake order and buy at the lower price. It is fraud. It is illegal. JP Morgan paid $920 million in fines, the largest penalty ever imposed by the CFTC. But it gets worse. The traders who ran the scheme went to federal prison. Michael Nowak, head of precious metals trading, convicted of racketeering. Racketeering, the same charge they use for the mafia. Greg Smith, convicted. Jeffrey Ruffo, convicted. Christopher Jordan, convicted. Real people. Real prison sentences for running a criminal enterprise inside one of the biggest banks in the world. And JP Morgan was not alone. Scotiabank, convicted. $127 million fine. HSBC, convicted. $76 million. 9 years of fraud. Deutsche Bank, convicted. $75 million. 15 years of rigging markets. Morgan Stanley, convicted. 5 banks, all guilty, all fined, and not one of them lost their trading license. They paid the fine and went right back to work. $920 million sounds like a lot, but JP Morgan made over $40 billion in profit in 2020 alone. The fine was a rounding error, a cost of doing business, a speeding ticket. Now ask yourself this. Do you really think they stopped? These are the same people. The same trading desks, the same strategies, the same incentives. They got caught. They paid. And then what? They just decided to play fair? On January 30th, 2026, JP Morgan closed 147 silver contracts at the exact bottom of a 39% crash. The same bank convicted of rigging this exact market. Perfect timing, again. But wait, look at the rest of the document. Morgan Stanley. 31 contracts stopped at the bottom. Deutsche Bank, 58 contracts stopped. HSBC, 60 contracts stopped. The same criminals, the same names, all closing shorts on the same day, all exiting at the exact bottom. This is not a conspiracy theory. This is a government document, public record. Anyone can verify it. The evidence is right there in black and white. Now let me show you what happened next. Friday night, after the crash, the CME Group announced margin requirement increases. If you hold a silver futures contract, you need a certain amount of cash in your account. Margin. If margins go up, you need more cash. Most traders do not have extra cash sitting around, so they get liquidated, forced to sell, whether they want to or not, Saturday morning, less than 24 hours later. CME announced another round of margin hikes. 36% increase overnight, gold up 33%, silver up 36%, platinum, palladium, everything. Let me make sure you understand how insane this is. If you survived Friday's crash, if you held your position through the bloodbath, Saturday morning you suddenly need 36% more cash or you get liquidated anyway. The crash wiped out the leveraged longs. The margin hikes finished off the survivors. This is not risk management. This is execution. And it tells me something very important. Someone big is in trouble. You do not raise margins twice in 3 days to emergency levels unless someone is about to default. Someone has massive losing positions. Someone is underwater, and the CME is scrambling to protect the clearing system from the fallout. But here is what should really disturb you. If CME wanted to prevent volatility, they would raise margins before a crash. They would cool the market down when things are getting too hot. That is what a responsible exchange does. Instead, they waited until after the destruction. Then they raised margins. Then they raised them again. Then they scheduled more hikes for the following week. They are not protecting investors. They are protecting the banks. And this is not the first time. 1980, silver ran from $6 to $50, 800% gain, regular people making fortunes, the Hunt brothers trying to corner the market, everyone talking about silver. What happened? The CME created Silver Rule 7, out of thin air, banned leveraged buying overnight, changed the rules in the middle of the game. No warning, no explanation, just new rules that destroyed anyone who was long. Result: silver crashed from 50 to 10. 80% destruction. Thousands of investors wiped out. 2011. Silver ran from $8 to $50. Another massive rally. Social media buzzing. Retail piling in. The silver squeeze movement born. What happened? CME raised margins 5 times in 9 days. 5 times. 84% increase in margin requirements. Result: silver crashed from 50 to 26. 50% destruction. It took 13 years to recover. 13 years, and now, 2026. Silver ran from 26 to 121. The biggest rally in history. Social media on fire. Retail euphoric. What happened? Margin hikes before the crash. Margin hikes during the crash. Margin hikes after the crash. China raised margins at the exact same time. Fed chairman announcement timed for maximum damage. Banks closed shorts at the exact bottom. Result: 39% crash in 6 hours. The fastest destruction of the 3. Once is an accident, twice is coincidence, 3 times is policy. But here is where it gets even crazier. While the paper price was crashing to $75, the physical market told a completely different story. Dealers around the world were selling 1-ounce silver coins for $120 to $150, a 40 to 100% premium over the paper price. If silver was really worth $75, why were buyers paying double? Why were coin shops sold out? Why was there a line at every dealer in America? The paper market and the physical market had completely disconnected. And then, this weekend, something happened that tells you everything. Golden State Mint, one of the largest private mints in America. They shut down silver sales for the entire weekend. Their statement: not able to secure silver. Let me say that again. One of the biggest mints in the country could not get silver. They had to stop selling because there was no metal available. The last time this happened was March 2020, the COVID panic, when the entire world was falling apart, when the financial system was on the edge of collapse. That is the only other time in recent history that a major mint had to shut down because they could not source metal. And it just happened again, right after Friday's crash. Think about what this means. The paper price says 75. But the physical market is so tight, so stressed, so completely broken, that one of the largest mints in America cannot even buy silver to sell to customers. If there was real silver available at $75, do you think Golden State Mint would shut down? Do you think they would turn away customers and lose revenue? No. They would be buying every ounce they could find. But they cannot find it, because it does not exist at these prices. The paper price is fake. The physical price is real. And the gap between them is not just wide anymore. It is shattered. Friday did not just crash the price. Friday broke the physical silver market. The cracks are spreading faster than they can contain them. Mints shutting down. Dealers sold out. Premiums through the roof. This is not what a healthy market looks like. This is what a market under extreme stress looks like. A market that is failing. Now let me tell you what I think happens next. The shorts have covered. JP Morgan closed at the bottom. The other convicted banks followed. The manipulation served its purpose. Weak hands wiped out, retail liquidated, leverage positions destroyed. The market has been cleaned. But here is what they cannot control. The supply situation has not changed. Silver is not optional. Solar panels need it. Electric vehicles need it. Every phone and computer on the planet needs it. You cannot build the modern world without silver. Demand is exploding. Supply is flat. Friday's crash did not create new mines. It did not reduce industrial demand. It did not change the fundamentals. All it did was transfer silver from weak hands to strong hands at artificially low prices. And now the physical market is breaking in real time. When this turns, it will turn violently. The same algorithms that drove it down will drive it up. The same leverage that destroyed people will create fortunes on the way back. And the physical shortage is only going to get worse. Because every crash like this drives more people to buy physical, more people to take delivery, more people to remove their silver from the paper system entirely. The banks can manipulate the paper price, but they cannot print physical metal. And right now, the physical market is screaming that something is very wrong. I also think something bigger is coming. The margin hikes tell me someone is in serious trouble. You do not raise margins 36% twice in 3 days unless someone is about to blow up. The coordinated timing tells me this is global. The physical market breaking tells me the stress is real. When a major mint cannot source silver, when premiums are 50 to 100% over spot, when dealers are turning away customers, that is not normal volatility. That is a system under extreme stress. Something is breaking behind the scenes. I have seen these patterns before, 2008, 2020. The stress always shows up in strange places before the big crash hits, and right now, the stress is everywhere. In the margin hikes, in the physical shortages, in the desperate timing of the Fed chairman announcement, in the coordinated actions between CME and China. I believe a major market event is coming in the next few months. Let me leave you with this. 5 banks convicted of rigging precious metals. Hundreds of thousands of fraudulent orders. Traders sent to federal prison. And on January 30th, 2026, those same banks closed their silver shorts at the exact bottom of the biggest crash in history. The miners did not crash because smart money knew. The physical market did not crash because the paper price is a lie. Golden State Mint shut down this weekend because they could not find metal. The last time that happened was COVID. The physical market is breaking right now. In real time, 1980, 2011, 2026, 3 times in 50 years. Same playbook, same destruction, same recovery after. This is not a free market. This is a crime scene. The evidence is public. The names are on record. The documents are accessible to anyone. They convicted themselves. They paid the fines. They went to prison. And then they did it again. The question is not whether this was fraud. The evidence answers that. The question is what happens when the physical market finally breaks completely. When the mints cannot source metal at any price. When industrial users start hoarding. When the paper contracts cannot be delivered. Sovereignty is solvency. But in commodities, price is supply, and the supply is gone. The ledger does not lie. The banks close their shorts. The mints cannot find metal. The premiums are doubling. The margins are spiking. The pattern is repeating. History does not repeat, but it rhymes. And right now, it is rhyming perfectly. That is how they have always won. Crash the price, create fear, buy from the panicked at the bottom. But the miners did not sell. Smart money did not sell. The physical buyers did not sell. They know what this is. And now you know too. The game is rigged. But the ledger always balances. And when it does, the people holding real assets will be the only ones left standing. This is the hidden economy, the truth behind the headlines, the numbers behind the narrative, the evidence that everyone can see but nobody wants to acknowledge. Because acknowledging it means admitting the entire system is built on fraud. And fraud only works when people believe the lie. Stop believing. Start reading the ledger. This is how they lose. If you want to stay ahead of what is coming, subscribe to this channel right now. hit the notification bell, because the next video might be the warning that saves your portfolio. Most people will not see this until it is too late. Most people will not understand what these documents mean until the crisis is already here. But you are not most people. You are here. You are paying attention. You are reading the ledger while everyone else is reading headlines. That is the difference between the people who survive and the people who get wiped out. The fraud is exposed. The evidence is clear. The names are on the record. They want you to panic. They want you to sell. They want you to believe the paper price is real. It is not. That is how they win.